Great. Thanks, Lou, for setting this up. And Steve, welcome everybody back. Sorry to take you away from the coffee break and the great socializing and networking. My name is Michael Logan. I'm the managing partner of Blackline Capital Partners, a private equity firm both based in Dallas, focused on food and beverage. Can everybody hear me, by the way? I'm not going to use a mic because my voice carries okay. Are you guys okay back there? Or maybe they don't want to hear me back there? That's okay too. Okay, great. So welcome. We're going to spend a little bit of time talking a little further on another angle at food and beverage. We have a great panel here with us today, and they're going to share some insights with us. So I'm going to just do a brief introduction of the panelists, starting from your right. The audience is right. Kathy Jaros is a managing director at the Peakstone Group, where she leads the food and beverage practice. And has been working in this sector for a long time, both in industry, at a number of great, legendary food packaging businesses in the Chicago area, the mecca of food packaging, I guess you could say. Notably, she worked with one of my favorite CEOs in the food business, Jim Kilts. So that's worthy enough for you to be on this panel right there. Okay. Next is John Rico. He is the food and beverage industry expert at Stout, a leading valuation and M&A advisory firm based here in Chicago. John is also an engineer by training. There's a funny anecdote I have from a private equity investor down in Austin. Hope people can still hear me. Sorry, I don't mean to mumble out there. But this guy named Robert Smith, who founded Vista Equity Partners, he went to business school and he said, I really don't take this the wrong way. He said, I really don't like investment bankers because when he was in business school because they thought they knew everything when he got there. And he said, but I was an engineer and I actually did know everything. So John is both. He actually knows everything because he's an engineer and he thinks he knows everything because he's an investment banker. Checks both boxes. Bob Decker leads the food and beverage practice at Balmoral Advisors. He is a long-standing advisor to companies here in the Midwest area, and most notably, he has led the ACG Food Conference the past 2 years, which I've enjoyed attending. It was great because I didn't see a lot of private equity people there, as many as I don't really like seeing them at conferences, respectfully. But so it's been fun to go to. I learned a lot. I learned about gut health and kombucha and all sorts of great things at this year's ACG Food Conference. And finally, we have Nate Asmussen, who works for Craig Hallam, which is a Minneapolis-based investment bank. Are you based in here?
I'm based here, yeah.
Based here. Craig Hallam is a long-standing investment bank in the Minneapolis area, which in and of itself has its own ecosystem and legacy in the food and beverage space with a number of great food companies and, frankly, food and beverage advisors up there who have their practices based up there. You need that? Sorry. I'm sorry. I'll borrow his. You can leave that over there. Okay, so hopefully... Okay, so I won't bother repeating those jokes and those introductions. We'll just assume that's good enough. We'll just jump into the panel a little bit here and talk about the M&A market in food and beverage and go through a few questions. We're going to talk for a little bit, but we're going to leave time at the end for all of you to ask any questions you may have. So get those questions ready. And if you have a question while we're talking, we're happy to field that as well. So feel free to butt in on us and just somehow get one of our attention, and I'm sure we'll stop whatever we're saying in time. Okay, so let's start a little bit with the M&A market in food and beverage. Maybe we can ask a basic question. I think the title, which I came up with, unfortunately for this panel, was Selling in a White-Hot Market. Is this a white-hot market? So, Kathy, why don't we start with you on that?
Greetings to everybody. Thank you for attending our panel. Survived the break. Is the market a white-hot market? And I would say yes and no. If you are a profitable, well-managed company, data-driven, you will get extraordinary multiples today. If you are a company that is much less sophisticated, perhaps sub EBITDA margin in your sector, somebody will buy you, but not at a white-hot multiple. If you look at the total number of food deals in 19 and 18, that number is really down versus the heyday of 16 and 17, where extraordinarily high prices were being paid, whether you're Kellogg's buying our Expire or some of the SoftBank investments that were made in the food sector. And that has tapered off somewhat. The things that I have noticed as we take a company to market is you see an incredible range of valuations, where the middle of the market are probably, the most sophisticated players, many with a strategic angle. And there are folks on both sides that are way overpaying, although I'd never say that to a buyer, or not even thinking about how to value the company. So yes and no.
Great. Great. It seems, I think our sector seems like it has a lot of capital in it right now. Interest rates have been low for a long time, 10 years. So it's interesting that perhaps there's been a slight pause in activity or a lessening of the frothiness in this market that you're noticing, observing. Maybe John, I'll go next to you. Are there any categories that you're seeing are in the food and beverage sector that you're seeing some keen interest?
Yeah, it's interesting. Clearly, you mentioned our expire, which was kind of a seminal transaction. That the branded consumer deals continue to trade at multiples of revenue, impressive multiples of revenue, right? Those tend to be few and far between. Broadly speaking, private label continues to show interest amongst buyers. It's very easy to scale up in private label without the investment in your own brands. It's interesting if you look over the last 4 or 5 years. For whatever reason, certain subcategories come into favor versus not. For a while, distribution, food service distribution was quite hot. There's a couple of large private equity groups that are rolling into space. When the RXBAR, come back to that, when the RXBAR announced, we saw a lot of the smaller brands that are the energy bars kind of trending to Me Too movement there. Using Me Too as a different concept. Beverages, coffee was white hot for a while. There's been a rash of protein-related transactions that have hit. So it's just, I want to say there's rhyme or reason. It's just interesting how these subcategories come in and out. Packaged manufacturer's always been strong, right? That doesn't go anywhere. But some of the smaller subcategories continue to come in and out. Clearly anything, and the panelists here know this as well as I do, anything on the perimeter of the store is going to attract interest as the center of the store continues to contract on the retail side. And so if you're not, number one or number two player, it's better to be Kraft. We were talking about Kraft. It's better to be Kraft than Unilever in the center of the store, which might have a second or third tier sometimes. But anything on that perimeter is going to attract interest from buyers. That's broadly speaking what we're seeing.
Great. Bob, maybe I could ask you the next question. Are there any categories that are not attracting attention from buyers that you have observed or heard about or seen, experienced?
Well, certainly retail is a very tough sector to be in right now. I think people are still trying to figure out all the dynamics of how they are going to get food products in the consumer's hands. You see Amazon is becoming a big player there. Obviously, you have the big box retailers that have all gone into the grocery market. Look what Walmart did from the time they decided they wanted to be in the grocery business. They are by far the biggest grocery retailer in the country. But so retail has been obviously very difficult. I do a little bit of work in the cannabis space. That's been obviously very difficult, or the market's closed as far as anything in the public markets and the IPOs. I think there's still some unique opportunities on the private investment side. One of the categories that's surprised me with its strength for a long period of time is the restaurant business. Restaurants have historically had 2-3 year runs, and maybe with 1 year exception, there's been probably an 8-year bull market in restaurants, and they actually popped up in valuation recently after having gone down just a little bit. that may be a little bit, episodic for certain types of transactions that have happened. But, for the most part, it's less about category, I think, than it is about the individual company. And I think, the B2 companies, the companies that are selling commodities, the not value added, these are companies that are going to trade at 4 and 5 times EBITDA. But if you have a high growth company, if you have a lot of velocity, obviously they're going to trade at much higher multiples than that. So.
Great, thank you for that, Bob. Nate, maybe you could help us a little bit understand any red flags that you've seen drive buyers away from different assets that have been brought to market or introduced or run in processes.
Yeah, sure. I mean, I think there's a number of factors. I mean, even that the private equity panel spoke about earlier, there are factors that are maybe kind of the inverse of that. It's, very well-run companies, good management team, data-driven. Anything that's kind of on the inverse of that are things that create challenges. I've done a lot of work within the contract manufacturing space of food and beverage products, and we just did a pretty complicated carve-out deal, business of scale, but it'd been run not very efficiently. Management team, there'd been a lot of turnover, and so I think if there's sort of inherent cultural issues within the business around management is really a strategy. That's always going to be an issue. In the manufacturing business, customer concentration is always a big factor in terms of visibility into revenue. Those are kind of main factors. And I think somebody mentioned earlier today around quality. At the end of the day, within certainly the manufacturing side of it, quality is paramount. If there's ever been a recall or an issue, or even on the fringe of that, those are things that investors look at very, very seriously. And so I think businesses that have a very good track record, and that's an element of safety. So for example, as an investor, if you're going into it, ask the management team, what are the top things that you guys do day to day in terms of your morning meetings? And if it starts with safety, as a management team, I think that's something that you can sort of look and say that the business is being run in a sense of that's an area of paramount focus. So those are some issues or areas around where I think that either investors are focused on and issues to be mindful of from kind of a red flag standpoint.
What about customer concentration? It's very interesting because I work with a lot of assets with customer concentration, and I sort of think about I rationalize it perhaps incorrectly that this industry is dominated by big companies, frankly. So maybe that's just me rationalizing it. Maybe I'm the only guy rationalizing it, but that is a red flag for just about all the 6,000 private equity firms out there. When the analyst takes it up the chain, it's got 30% with one customer. Basically, that's easy quick no in the private equity world. But if you got to look a little deeper, so someone comment on that. Is that a red flag or is it not?
Yeah, I think it's just tough to get away from anything consumer facing and food and beverage. I mean, Walmart is they're a good reason why you want to stay away from customer concentration. They can be brutal, and if you have one slip up with Walmart, they will punish you severely. But yeah, and it's tough to get away from it, and it's amazing how large the company can get in food and beverage and still have customer concentration, which maybe you don't see in other end markets. But it's not uncommon to see 30-40% for your top customer, and you combine your top 3 or 4 and you're 70-80%. So it's just tough to get away from. I know what you guys see.
Yeah. Some of the deals I have seen fail recently, or were certainly workout situations, were all around customer concentration. They might have 40% going to Trader Joe's, or 30% going to Costco, and those are fickle customers. And if you stub your toe, if you have a food safety issue, you're out of there, and you can never get back. And it's very hard to recover on those. So I agree with you that I think, next to velocity of sales at retail, that customer concentration is probably one of the biggest issues out there.
And I think the other thing that we saw recently was like you said, I mean, customer concentration is going to exist for a lot of these manufacturing companies. It just is going to. But I think what's happened certainly over the last number of years, as the big CPGs are sort of they've got SKU proliferation, but they've been trying to figure out how to deal with the emerging brands. And so I think that's going to be the next sort of wave of it within the manufacturing side is are there going to be, certain winners that are going to kind of win out that are on the emerging trend, right? So a lot of the small guys are dependent upon contract manufacturing or manufacturers, but they're going to get to a point of critical scale. If there's going to be a winner, they're going to get to a point of critical scale where the small mom and pop manufacturer, is maybe not going to be as well suited from a quality standpoint and allow them to scale. And so, I think, those are the businesses, the manufacturers of scale that can not only do the big CPGs because they provide volume and stability to some degree, but also have balance on, being able to deal with the emerging brands, and whether it's offering formulation, product development, other value-added elements is where I think you can begin to sort of mitigate that risk, or companies can kind of begin to mitigate that risk around concentration over time.
It's interesting because I own a beverage company once that had 90% customer concentration, and it's a red flag for, so many people won't look at the business. And frankly, the bigger part for the investor is, how are you going to finance this business? Because the lender has to somehow get his mind around it, and he doesn't have, in general, he's not going to have a swing at a double-digit IRR. What he sees is, if something happens, which I'm being told will not happen, I might not be working here anymore. So, it's a struggle for, I think, for a financial sponsor or private equity person to put that deal together without a supportive financing partner, frankly. Even with people adjusting in their minds for the fact that this is a highly concentrated industry in general. I don't know if anyone will comment on.
We are selling more and more businesses to strategics, very large strategics, and they come in at a much higher multiple, and they know what they're doing. And then you get a group of sophisticated private equity folks with reputations that were on the...
Mike.
It's not on?
It's on, just gotta keep it right next to your mouth.
Okay, and you get very sophisticated private equity, and they're disciplined, and they'll do their homework. There are so many new funds out there. An individual who gets backed by somebody, smaller pledge funds, and they're the ones that are really, I want to say, distorting the market in many ways, and either going too high or too low. And so again, it's a whole range. It's not any one buyer or any one issue. It all depends on the company and the right match with yourself.
What about, I'm sorry, did you want to say something about it? Go ahead.
You were talking about just financing. I guess, Kathy, I think what I've seen in the marketplace is a little pullback from the strategics. I think because there were some notable, call them not necessarily failures, but way overpaying for it, whether RX Bar or Crave Bar. Neither one of those was a good return on investment for their buyers. So you've seen a little pullback. General Mills, I believe, has closed down its corporate venture arm. And so we have seen a little bit of pullback from the strategic side, but no pullback on the private equity side. And then, so you ask about debt financing. I think, there are still 2.5 to 3 turns of senior debt, maybe a little bit more, up to 4.5 times of total debt on these deals. And if you get into the larger transactions up into the upper middle market, you're probably about a turn higher on these, particularly if they're stable, not too much customer concentration, and still growing.
What about over-equitizing to get around these issues, these red flags? Things that perhaps a lender would not support a sponsor with. Sorry, I'm speaking as a sponsor, so you're getting this bias. I apologize, but if I can't get full support from a lender to go to the full whatever, I've heard people go a lot more aggressive than what you just said, Bob. Have you seen examples of financial sponsors, private equity firms, and maybe you haven't, that's okay, I'm just tossing this out as a hypothetical. People saying, okay, well, I'll lay down a 50% or a 60% equity check just to make sure that we don't have any problems getting that third-party debt financing. Okay, that's just not a realistic hypothetical case.
For the growth companies, absolutely, they need to be over-equitized. And so if you're making an acquisition, and we even have some instances where we're really going out to raise a growth capital, but it's frequently a change of control if it's a young emerging growth company that needs a lot of capital. So over-equitizing is definitely something that's happening more and more today.
We've had banks attend management meetings along with the sponsor. And, they wanted to make sure that, the story was clear, that the bank had already met the management team, so that when they submitted a final bid, things would go very smoothly, and they could take away that contingency clause of, gotta get financing for this. Because one of the things that we look for in any buyer is certainty. Can they get the deal done in the right amount of time at whatever the terms are in the letter? And so, if you want to bring your banker along and they've signed the appropriate confidentiality agreements, please feel free.
Yeah, the only thing I would say to that, and I agree with everything the panel said, we talk about red flags. If you have absence of red flags, in and of itself can drive tremendous multiples. So you guys are
Yes,
laughing.
I agree.
So you have something that might grow at single digits, but it's have relative consistency, doesn't have customer concentration, doesn't have supplier concentration, has no major hiccups, and all of a sudden you see leverage reads 5, 6, 7 times. It's crazy.
No equity. At that point, no equity.
No equity is required.
Yeah, right.
That was a joke, by the way.
Yeah, I know. So it's an absence of bad news in addition to growth companies that can drive just astronomical / ridiculous valuations, which is a little twist on maybe what we've seen historically.
What about a red flag? So one of the red flags, I just looked at a nut processing business down near where I am, and this was touched on by the prior panel, but it increasingly becomes part of my thinking as I think about it as a buyer, actually. And that is this a management team that I can trust to be a steward of my capital, frankly? I mean, I'm a fiduciary. I have customers, and they want their money back in multiples. So, if this guy's not saying the right words, there's no way I can bring someone else's money to the table. Any comments on that one? It seems like a red flag to me, by the way.
Yeah, I mean, from an investor standpoint, I think that's probably among the other, primary ones, is does the management team, one, do they have a strategy, and two, do they have sort of command of the business? And I think one of the panelists earlier mentioned just, the data and the analytics as being really important. Understanding unit economics, efficiencies, where are the roadblocks in the business, and even just, how is the management style and how does that sort of trickle down? All those things are incredibly important, as investors look at it. So, in addition to that, I think it's also, even when we're managing processes, it's also being, open-minded around where are there gaps. And, certain investors can bring things to the table when you're saying, look, we know that there's a gap, either if it's in the CFO role, for example, or, the sales side is weak. It's also trying to find the right partner that can bring something to the table that is the right solution for the business. So, that's kind of our, I try to approach that of, here are the areas of strength, but also where are the areas of weakness, so that, where everybody's going into a deal eyes wide open, because you don't want to have any surprises.
I think part of it's going to be dictated by whether it's a platform investment or an add-on deal. I think, as Robert Brown said, you figure it out over time. The management teams that get it, that understand their KPIs, that are data-driven. Management is first and foremost in our mind, even when we're working with a company that we're selling. We need to know that if we take them out on the road, that they're going to be credible people when we're talking to buyers out there.
Yeah, it's interesting because in another example that I can think of, and I'm just tossing out examples here to put some meat on the bones here, and let the panel react. This is not on the question sheet. But, I ask, obviously part of my mission as a buyer is to go in and figure out what is this guy going to be like after we own the business. I don't care about what he looks like after he's gone through the management presentation. That's a different ballgame. I'm talking about after, but you guys are long gone after we own the business, right? Respect it. So that's sort of the puzzle I'm trying to figure out. What is this guy? How is he going to be like to work with, frankly? What is he in a natural state as a partner? So I tend to try and make the seller, as comfortable as I can, frankly, in whatever setting we're in, so that I can try and get to the natural state, not the coach state, but the natural state. And one of the open-ended questions I asked was, how do you expect the business to change if there were an investment transaction by us or someone else? And the answer was, well, it's pretty much going to be around the same way as it is today. And this is a guy who was in his 70s, and he had 2 son-in-laws in the business, and he just basically said, I think we could just keep it all the same. I said, what about, one of your son-in-laws has been here for 20 years, well, maybe we should make him a president or something like that. And he said, no, I'm not that much into titles, actually. And he was the head of general manager at the time. So, I'm thinking to myself, is this a guy, as a fiduciary, I have to, this has to be a presentable company to my customers, actually. And there has to be some sort of effort to return the capital, frankly. And, frankly, I was a little disappointed that his advisor, who was in the room when I was trying to make him comfortable, didn't say, didn't get him to say something that I thought would have been more appropriate in a situation like, I'm looking for a partner to share whatever, the challenges that we're facing, or I'm looking to transition, since I'm 73 years old, I'm not going to live forever. Those weren't the words that came out. So that was disappointing for me. And that's a red flag for me. That's a red flag. That stopped me dead in my tracks in this meeting. So anyway, any comments on that? Maybe not. That's okay for now.
I would just have one of the things that I look at when evaluating a prospect is, and I'm sure the panelists are the same, go on a plant tour, right? It's very illustrative. And as you go through the plant tour, watch how the employee base, if it's a manufacturing business, reacts to their boss walking the floor. Is it one of collegiality, where you pass them on the shoulder and ask about their child or their wife or their brother? Or is there, does it feel like the employee base doesn't see you and the head's down, and then as soon as you walk past, you look back and they're looking out of the corner of their eye? And that, what does that tell you about the culture of that business? And more than anything else, other than maybe the financials, I found that to be illustrative of the dynamic about, these are people that work with that person day in, day out. How do they react? And if you think you're going to be different than that, you gotta look for something. I don't know if others have seen that same experience.
I'm going to echo what you just said, I think, or reinforce what you just said. I'm actually working on the buy side of a transaction that Kathy's working on the sell side. And we brought our buyers through the first time, and we walk into the employee lunchroom, and I said, who should we be? Are we bankers? Are we, insurance guys? And because a lot of people don't want to see buyers coming through. They don't want to alert their employees to that. And they said, oh no, the employees know exactly what's happening. They're excited about this. And there up on the wall was daily sales reports. And I said, okay, this is a really interesting company, well run, with a management team that's very close. And as you walk through the plant, you could see the management team interacting with all of their employees, which is really refreshing.
One of the things that we try and do, just like the private equity folks evaluate a company to purchase, we try and evaluate a company, who we think can be sold and sold well. And so we will either turn deals down. We probably turn down more deals than we actually accept. We'll talk to companies and say, we just canceled the meeting on a pitch next week. We said, you're not ready to be sold. And these are 5 things that we think you need to do. And over time, if they're willing to do those and they demonstrate, yes, we can accomplish these things. It drives the value that they're hoping to get out of their company. I sold a company last spring. I'd been talking with this company for 5 years. And everything that needed to be done, there was a new CFO, no customer concentration, broadened the product line, everything was done to the point that, we got an extraordinary multiple for them because the company showed very well. And I think as a banker, you have to feel proud of the clients that you represent and that you show to buyers that they come to rely on us doing some screening, long before we ever take a company to market.
maybe you could comment a little. I always wondered about this side of it. What about, is there an evaluation of the coachability of the client? Because if that guy who was, the 73-year-old guy, was properly coached, or if he accepted the coaching, whatever, I'm not going to say he wasn't properly coached, if he accepted the coaching, the correct words would have come out of his mouth, and frankly, in my sector, we are so desperate to put money to work, I would have believed the guy. That's the funny part. I was desperate to believe the guy, but I didn't even get the correct canned answer, actually. So, any comment on coachability? Or maybe not, maybe that's not something we do, you know. That's something I guess we should be doing too, on our side, is this coachable?
Yeah, I mean, yes. That's all. I mean, it's really frustrating when you're in an MP and the wrong answer comes out, and you think to yourself, "I thought we talked about this already." Yeah, it's a major issue, and it's personality specific, and there's no clear correlation too. I can't say that you can't teach an old dog new tricks. If somebody is in their 70s or 80s, that they're not coachable, you could have a bigger issue with somebody in their 40s. So there's no clear correlation.
One of the things we really like to see is somebody who's a Vistage group member, where, you know, they go in with their peers, they've learned to communicate, they have learned, you know, over the last 5-10 years, you know, what a well-run company is supposed to look at, and they get feedback long before we ever meet them. And for a more traditional company, not something that was founded by a, you know, 25-year-old, that's always a comforting thing to me, because you believe that they are coachable, that they've heard what advice we're going to give them before, and they know how to listen.
Yeah, but I think the phrase that I try to use a lot is just be open-minded. You know, in these deals, as you know, even though you begin to go down a process, you know, ultimately you never know what's going to unfold. And so I think, you know, how open-minded is a founder or entrepreneur, or whoever the client is, you know, how open-minded are they to it, I think is sort of a way to kind of understand the coachability and how they think about the world. Because like I said, I mean, as you go through the process, you know, what you think is going to happen at the outset is completely, you know, versus what actually happens is usually always completely different. So.
Yeah, I don't think the guy I was speaking to would have been open-minded to me, frankly. And that was my takeaway from that sort of interaction, frankly. Anyway, the bottom. Let's shift gears a little bit here. We touched on this a little bit. What factors? We already mentioned a few already, so let's not re-mention the ones that never mentioned already. Things that lead to aggressive, frothy bidding. Obviously, I heard debt financing. I heard independent pledge fund, independent sponsors, people just bidding irrationally. Anything else come to mind that leads to frothy bidding? Other than a clean, you know, obviously a very clean business, no customer concentration, steady profitability. Going to get a lot of bids. We all have seen it. We've seen the dozens and dozens of bids come in. I get it. I've seen it too. They go at high multiples. What else? What else leads to frothy bidding? That any of those examples other than the obvious ones that I just.
Velocity at retail. Everything's about velocity right now. How quickly are you turning your products? And if you don't have velocity at retail, you're not going to have the revenue. You're not going to have the scale. You're not going to have the margins. So, but growth without profitability today is also frowned upon. Used to be, hey, grow at any cost and don't worry, profitability will follow. That's not so true today. So to get the big multiple today, you have to have high growth with profitability.
Yeah, I would, and you touched on this, Bob, but you think back in past processes that had outsized returns from an expectation point of view. You know, something we talked about, lack of bad management teams and margins. I mean, those three items will almost always determine your multiple. I guess the last thing would be end market / category. If you're in a category that's growing exponentially, that also will be the last thing, you know, as opposed to something that's not. Again, this isn't rocket science, right? It's the same across any end market. Food just, for whatever reason, seems to amplify some of these, both at the highs and lows.
And maybe the other addition to that would just be, you know, sustainability of the growth profile or sustainability of the cash flow profile of the business. You know, how cyclical is it, or how is it, you know, how much exposure does it have to changes in consumer preferences? I think that's certainly a factor. You know, working on a grocery deal, East Coast-based grocery deal, that is highly differentiated, but, you know, the theme, I think, that we've mentioned here today around convenience, grab and go, prepared foods, you know, I think that's a sustainable long-term trend that's going to exist. And, you know, they're producing, you know, almost like half the products that are sold in the store. And so it's one that's very differentiated, very unique, and I think the trend that they've kind of hit on and the theme is sustainable. So I think that's another factor.
Okay, what about, let's shifting gears a little bit, what about adjustments to EBITDA? I just came back from seeing the Vice Chairman of Berkshire Hathaway speak last week in Los Angeles, and he went off on adjustments to EBITDA, and basically private equity as an entire industry. He just thought it was a ridiculous industry. But is this such a frothy market that no one challenges the adjustments to EBITDA, or do people challenge them? I don't know. You know, I mean, what anything on that? What can I do to fight that EBITDA?
Well, probably the new banker favorite is the run rate adjustment, right? So, I think, well, and I think another thing that you're seeing happen a lot is the sell side QV has become almost mandatory, regardless of almost deal size. I think so the accounting firms have done an excellent job of having that become sort of a mandatory, effort. And, I think it is worthwhile because I do think it takes away, a fair amount of sort of the, ambiguity or sort of the banker speak around, adjustments in there. But I think that, the biggest piece is just, how credible is it, going back to the sustainability piece, if there is, for example, using the run rate thing, the only way you're going to get credit for it as a banker on the sell side is if it's real, if you can prove and demonstrate that it's, that it's real. And so, from my standpoint, I don't want to take a business to market if there is some underlying major change in the business that's going to have an impact on profitability in the future that we can have, even if we have a 6 to 12 month window, I'd rather get true credit for that if we can kind of prove out, elements of it. So, but the run rate one is probably the one that you see most often where people get very, very creative.
Want to say something?
Yeah, take out the obvious things, the excess owner's comp, the insurance, all the things that they load up on their companies. We've seen a lot of one-time events that seem to happen every year that people are doing as add backs. Yeah, recurring, non-recurring. Thank you. That's the theme. Years ago, I worked with a company that was they owned daily fee golf courses, and whenever the subject of weather came up, it was a shitty weather year last year. It's like, okay, you're going to have bad weather years or you're going to have good weather years, but that was just not an excuse. That was not an add back for that business. Now, maybe you could normalize the earnings over a 5-year period for that, but some of the add backs do just get a little silly. So
We get it. I get it. You have a client too. Everyone's got a client. We're all working for different clients. I get it. And it's interesting because a couple of anecdotes on that front. I mean, I looked at a honey business a while back, and there was an ad back for problems they had starting up a second plant. And it turned, I submitted a bid for this thing, and they said, yeah, we need 9 times the number with that ad back. I'm like, wow, okay, so we're paying you for that screw up, actually. Okay, I get it. That's the mark. But my industry is in a frothy state. It may not show up in your side, but it's showing up. I think it's frothy on my side. The other example I had was actually I forgot that one too. So that's another of those examples. Okay, here's one question. This is not on the question sheet too, so I'm on a roll here a little bit. So we're just going to keep asking, keep you guys on your toes, and myself, by the way. So what about, are we seeing any kind of prevalence of rep and warranty insurance in processes? Is this becoming the new market? I'm a lawyer by training, so actually this is a hypothetical back when I was a lawyer many years ago.
Yeah, it's amazing how that product has evolved and come down market. The pricing has come down dramatically. Retention has come down below what we saw even a couple of years ago. What we're seeing now on the more attractive assets for sale is public company style deals, which is amazing, where all of your reps and warranties expire at close, and all you're left with is recourse as a buyer is the insurance policy, with maybe an exception or two. the first time I heard about this was 12, 18 months ago. And it's kind of a weird dynamic, right? Then what are you negotiating as part of the SBA? You're basically negotiating for disclosure schedules, in essence, because again, all these reps expire and close, and so that it's just, I've been doing this a while. It's just a dramatic change, and it really is going to change the way we do our business.
Sounds like a frothy market to me right there.
It is, and whether that's sustainable, I guess we have a valuation practice that focuses on rep and warranty disputes. And so how that product evolves over time will probably be a function of how these policies litigate over the next 5 years or so. But right now, you can't imagine this being a sustainable dynamic. Or maybe it is. Maybe it's the new normal. I just don't know.
Have you ever seen payouts on these? I mean, I've heard stories about the payouts, but when push comes to shove and they actually go to try to collect on some of these reps and warranty insurance, I hear it's a very difficult process.
Well, the best way to make money as an insurance company is to take in premiums and not pay out claims. And I think that's what you're going to see. But anyway, for rep and warranty, it's just amazing.
Yeah, it's interesting. There's a couple. I know a little about the insurance industry, even though I focus on food and beverage, and I think it's interesting because there's been a lot of money since we've had such a low interest rate. There's a lot of money flowing into the insurance industry, and this product has brought down the premiums quite a bit, frankly. And the other thing is the claims history is not quite very long on this, actually. So we actually don't know the claims history on this just yet. It's still coming in over the years. So I think the jury is out as to the sustainability of this megatrend that we're seeing come, obviously, from the big cap companies and private equity to the small ones, actually. But we'll see what happens there. Okay, terrific. We touched on this earlier. By the way, I'm going to pause. Is there any questions? Just raise a hand. We talked a little bit about the market earlier. And my next question is about whether purchase price multiples are plateauing. Kathy gave us some color on that. If people want to add anything to that, we can talk about that, or I can show a couple slides on it. Did anyone want to add any color on markets, the multiples plateauing or anything like that?
I think one of the things that's keeping a cap on multiples is that banks have been anticipating a recession for the last how many years that hasn't showed up yet, and so they've kept a more conservative, particularly in the last year, perspective on how much debt they're willing to put into a deal, and so that I think has been one of the drivers of stabilizing the multiples. I don't think they've gone down in any way, but they've plateaued by deal size.
Yeah, I think that's right. I mean, I think beyond food and beverage, I think that theme is right. I think the long cycle that we're in, the long up cycle. I think people are, I just continuously hear the idea around recession. How do you sort of manage a business that may be a bit more cyclical? How do you manage those dynamics? So I think that investors are cautious, as they should be, in terms of finding the right assets to be investing in. Certainly within the lower middle market, sub 10, sub 15 of EBITDA. I don't see that they're going to just go crazy. I think they are kind of plateaued, and just people are trying to be pretty prudent and prepared for an eventual down cycle, whatever that looks like.
Yeah, I can't fathom multiples going higher than they are. We said that 3-4 years ago, and then they went higher. But I think we've seen some stability in terms of the upper level the last 24, 36 months. The dynamic, Kathy talked to the bank lenders. The non-bank lenders have been equally aggressive, and there's been some significant new entrants into that space that I think will continue to sustain multiples, even if the traditional bank lenders pull back. There's so much money sitting at the debt fund level that it has to be put to work, just like the equities you have that pull. But I just can't fathom them going higher than they are today.
Yeah, and just to be, hopefully everyone knows what he means by that, but the regulated banks, the traditional banks that we all used to go to for debt financing and private equity, they sort of have the regulator handcuffs on them a little bit for the moment. And there have been all sorts of people who aren't subject to Federal Reserve Bank regulations who are lending money to people like in my industry, not me, but other people actually. Okay, anyway, so I have a little data to share on plateauing, if I could indulge the panel. So let's see if I can get this to work. What do we have here? Okay, so this is not food and beverage data. Can the audience see those numbers by chance? We good? Okay, so this goes back to 2003 to 2018. I'll get the 2019 numbers next week. So next year we'll have to do this a week later, and I can show a current year number. But there is, first of all, the word I would use to describe this slide is breathtaking, because those are high multiples. In 06 and 07, those were historically high multiples back in 06 and 07, and apparently partly 08. But we've totally eclipsed that high water mark on a sustained basis, frankly. Maybe there's some plateauing going on in 2018. We'll know when the 2019 number comes in.
Have to keep in mind, of course, that multiples tend to be an inverse ratio to interest rates. And interest rates have been at such a low level for so long that where else do you go to seek yield? You know, you go seek it in equity, even if you're only looking at maybe a 10 or 12% yield. It's certainly a lot better than, you know, getting a short-term 2 or 3% yield. So,
yes, we get that question in our industry a lot from some of the people who invest in our industry, who are in the back of the room with a relative return versus the absolute return. It's still an apparently attractive relative return to our customer base, but I still think in absolute terms, I guess. I'm old school, I guess. This picture is obviously across all U.S. LBO transactions. But if we take it back and look at just peel this onion back a little bit to smaller businesses where I focus on, these would be businesses below $250 million in enterprise value. Sorry for all the numbers on here. You can just focus on this number right here, the total EBITDA enterprise value to EBITDA multiple. And you still see a fairly frothy number at 7.3, 7.2 the past 2 years. And perhaps a plateauing in 2019. This chart shows 2019, except it's a year-to-date number, so it's probably the first 3 quarters of 2019. Anyway, did you want to say something?
Yeah, we've seen this. I think if you kind of do one of these, you're probably looking at something that traded at 6 is now trading 7 to 8 times today, so that would be consistent with that data. 1 to 2, maybe 3 turns of EBITDA higher than the long-run historical average. And again, the question is, will we return to a more normalized? And then that comes to your question. You know, the question is, what is an appropriate level of return on basically an illiquid microcap company that's highly leveraged?
And highly risky too.
Yeah, highly risky.
Very risky.
Is 25%, which was the rule of thumb for a long time, is that an appropriate level of return for the risk you're taking on, which will triple your money in 5 years? I think, you know, this panel would say we're probably seeing PE pricing things. You don't know exactly what it is, but probably in the high teens, you know, 15 to 19, 15 to 20%. Is that the appropriate level? Maybe if you know, LIBOR is at, you know, sub 5, if LIBOR pops back up to 5, we don't know. We just don't know. But it's been now the expected returns have clearly been depressed, and will they rise again in a more normalized environment? I just don't know.
And I think Bob touched on the interest rate being a key driver of that dynamic, of these prices rising. And I don't know, the interest rates are still low, so I don't know why it's plateauing yet. But I haven't quite figured that one out yet, but keep going.
Yeah, well, I was going to say, it's interesting, if you run the LBO, your return as an equity holder really isn't that sensitive to the pricing of the debt. I mean, it is, but it isn't. It's much more sensitive to the availability of the debt. And now the question, is there a correlation between pricing and availability? One have to believe there is. So if pricing.
When you mean availability, do you mean the debt?
The amount of money, yep.
The amount of debt put on.
Exactly. So if you go from, you know, 5 times leverage available, 5 times EBITDA to 4, that's going to have a much more dramatic impact on your return and hence the price you can pay than if your interest rate goes from L plus 3 to L plus 4, right? So it's the availability that's really been driving the frothiness, even more so than the depressed interest rates.
Yeah, and obviously the non-regulated lenders are playing a big part of that, obviously. And the other key equation, obviously, other than availability debt and low interest rates, sorry to beat on this, but I'm going to roll here a little bit. So one more piece of data. The other big factor is the amount of dry powder available on the equity side. So this is another breathtaking slide of the amount of unspent LP commitments to financial sponsors. And forget about the stuff on the top, you know, we're mostly talking about buyout and other stuff like that. And these are breathtaking numbers, frankly. And that's a tsunami of dry powder that is looking for a home right now.
Yeah, it's crazy, right? I mean, PitchBook did a nice job. That was always what we used, because they're the only people that were paid, reported that stat. And for a long time, it was about 500 billion, which translates into plus or minus $1 trillion of purchasing power. And now I don't know what this says, but
This
I
is
think
$2 trillion total dry powder on the market in 18. It's going to be bigger in 19, obviously.
Yeah.
But this includes some other stuff too.
And I was talking just more equity, not debt. But I think
yeah. Just the equity alone has recently been estimated to be 1.5 trillion.
It's crazy, and the number of funds that have up tiered that used to be 250 to 500 that are now $1 billion. Yeah, I mean, and that's a totally different market. Totally different market. 5 to 10 of EBITDA versus 25 to 50. I don't know what to say.
Throw something back to you, Mike.
Go ahead. Shoot.
It seems that as these funds have gotten so much bigger, management fees have taken on a much more important role than the 20% carry on the back end. And talk to any of these billion-dollar funds, they'll give up the 20%, but they won't give up that 2% management fee, and that's a big number. Another dynamic.
I'm getting the wrap up here, Sign. I do think that's a case by case situation. I do think we have some limited partners in the room. I do think, although they would probably tell me they're price takers, I would say the billion-dollar funds are getting pushed back on the management fee, frankly, because you are drawing on a billion-dollar fund, you're drawing $20 million a year, frankly, and that's a lot of money, frankly. So anyway, sorry, did you want to say something?
Well, I was just going to say, as an offshoot to management fees, the proliferation of family offices right now are also a big factor, where they're directly investing in companies as opposed to becoming an LP in a fund. And that's another huge factor, putting the money to work into the market.
I'll build on that. It's not just family offices. Our LPs are going direct to market, frankly. They're bypassing the GPs to skip the 2% fee. That's the easier way to skip the 2% fee. It's not the easier, it's harder actually, but it is a way to get, you don't have to argue with the GP about their fee. You just say, I'll just do it myself. Forget you, we don't need you. One final slide, since I'm getting the hook here at this moment. This is a slide I have. It's a little dated, frankly, but the principle will hold true, and it shows the relationship between purchase price paid in green, yes, the green line, and then the blue line is return on investment by that vintage year. So there's no surprise that when in certain years when you've had low purchase prices, you've had the best returns in our sector, and in periods of high purchase price like 06 and 07, you get the worst returns in our sector. And frankly, this chart, we couldn't even fit it on the scale where the purchase prices are today, actually. So it's been a great market to sell businesses, and the jury's out on the returns. Maybe we'll buck the trend this time, and we will have better returns at these high purchase prices. I'll leave smarter people to figure that one out. Okay, I think we're done. Is that it? Or was there a question? Sorry.
Is that okay?
Question? Can we do a question or no? Okay, sorry, go ahead.
I just wanted to ask you about that thought, because I was going to ask about vintages. Is some of this being driven because the funds aren't holding the asset as long as they could? I mean, are they seeing the chance to flip? And is that what's driving some of these prices and some of the...
Are you talking about the purchase price multiples or the IRR? What are you referring to right now?
I'm talking about the purchase price multiples, if that's what's kind of driving some of it.
That's a question for you guys.
2 years ago, everything that is in any portfolio company of a private equity group was probably for sale. People were really pushing deals, and I think that is one of the drivers, to the number of transactions, is that, people were trying, good multiples are here, we're sellers. And that's changed now, and people are starting to rebuild, they've raised new funds, and I think they're being more reasonable.
One final thought on this. 15 years ago, you never saw a PE firm buy for another PE firm. Today, it's over 60% of the deals are PE firm to PE firm. So that tells you a lot.
Was there a few more questions? Fernando, why don't you go? What do you got?
Can someone comment? I read somewhere that the U.S. is becoming less entrepreneurial, so I'm wondering if you're seeing the same kind of, companies that you saw 5 years ago, because you're revisiting, because you're just not seeing, kind of the dynamism that you're looking for to warrant, higher multiples. I'm just curious about that.
Yeah, I don't know that I would agree with that. If there's any bankruptcy attorneys in the room, I think our bankruptcy laws are still among the friendliest in the world. So I don't know that I would agree with that statement that the U.S. is less entrepreneurial today than it was 5-10 years ago.
I was going to say, I mean, in particular within food and beverage, I mean, I think it's probably the inverse. I mean, years ago, you had just had, the big CPGs that dominated the market, and it was like there's almost no new entrants. The just proliferation of new brands, just given the consumer trends, I think is pretty amazing. You go to the grocery store, and it's a million brands you've never heard of that are getting shelf space. And you've had some pretty wild success stories that are out there. I mentioned the expire thing, but Simple Mills, it's based here in Chicago. I mean, that's a huge success story. So I think you're seeing more and more of that, just because consumer trends are changing, and if you have a good product that sort of is on trend, it's going to find a way to create sales.
Yeah, the other side of where I think a lot of innovation is coming is on the ag side, where you've got drones running up and down fields. We raised a bunch of money for a vertical farm last year, and it was AI, it was sensors, it was unbelievable regulation of environments and breeding of select seeds for the perfect tomato, and that was all innovation. I mean, it was a wonderful project, just personally to work on it, to see them, the collection of sciences that came together in food and agriculture. And so there's a lot of pockets that are extraordinary.
This is an online category, but it's being disrupted massively. In my opinion, it's being disrupted by a lot of young entrepreneurial people. So maybe that's true in other sectors, but this sector, in my opinion, could be characterized as a lot of entrepreneurship. Well, one more question back there, or two more?
I was just going to say, I mean, as the insurance broker in the room, I have to just touch on the reps piece. You guys are, understandably, I get your take on the insurance companies. We had about $50 million in payments last year. Food and beverage has one that'll blow through $100 million. The process has to be managed, right? You have to prove laws, multiples will apply. It's not perfect what they are paying. About 1 in 25 is a real claim that's paid, 1 in 5 is a notice. So it's there. The process has to be managed. You have to prove the loss. It takes about 6 months to a year. But it is working. And the reality is the underwriters have to justify their existence because there's a lot of recovering attorneys that are being paid big salaries, and if they're not going to pay the claims, they're in trouble. So.
Thank you for that comment. Did you have a question or a comment?
On the portfolio management side of the equation, and availability of capital, I suspect that we're not yet seeing the impact of increasing allocations to alternative investment categories like private equity. So I don't know if anyone's had any data on that point, but I'm seeing a lot of funds, a lot of pension funds pushing a higher allocation to alternative assets because they're not able to cover their contribution and distribution amounts.
I agree 100% with you.
I don't think it's over.
No, it's not over. It's clear the tsunami is just, it's only going to get bigger. In my opinion, it's going to get bigger. Okay, I think we're done. Thanks.